Hello, business development companies, innovation growth funds. David John Baptiste, back to me, of the Wellness Clarinet Ltd. What is a BDC? BDC stands for Business Development Companies. BDCs are a type of publicly traded private equities in the United States that invest in small, up-and-coming businesses. This form of company was created by Congress in 1980 as amendments to the Investment Company Acts of 1940. Hercules Technology Growth Capital Inc. defines a BDC as following. Congress created business development companies, BDCs, in 1980 to provide public investors another means to invest in the long-term growth of private US businesses. BDCs invest their capital primarily in small and middle market private companies in the US. Typically, BDCs are structured to originate and hold debt and equity investments to maturity and can invest across a portfolio company's capital structure. In order to qualify as a BDC, companies must be registered in compliance with Section 54 of the Investment Company Act of 1940. Amongst other restrictions, BDCs are required to maintain an asset coverage ratio of at least 200% in order to borrow or pay dividends and to meet specific asset diversification requirements. In addition, BDCs that are regulated investment companies for US federal income tax purposes, such as Hercules Technology Growth Capital, are required to distribute at least 90% of investment company taxable income to shareholders in order to avoid corporate income tax on distributed taxable income. BDCs are high-yielding, publicly listed venture capital firms without income tax. The section of Best BDCs. Criteria for selection of Best BDCs. Making loans safe. Do strong business. Generate positive cash flows. Risk analysis. Average grade of portfolio investments along with the debt to equity ratio for each. BDC analysis. 50 BDCs were analysed with their annual performance between August 3rd, 2012 and August 2nd, 2013. 50 BDCs were divided into three segments: big BDCs, medium BDCs, small BDCs. The annual performance of all these segments were measured. Big BDCs generated 44.9% with a dividend income of $1.60 or 6.5%. Medium BDCs generated 25.7% with a dividend income of $1.38 or 8.13%. Small BDCs generated 1.7% with a dividend income of $0.53, that's 53 cents, or 4.722%. BDC regulation. BDCs must be subject to all relevant provisions of the Investment Company Act, which limits how much debt a BDC can incur, prohibits certain types of affiliated transactions, requires a code of ethics and a comprehensive compliance program, and requires regulation by the SEC or Securities and Exchange Commission and subject to regular examination like all mutual funds and closed-end funds. BDCs, as regulated investment companies, must distribute at least 90% of all taxable income to investors. Risk mitigation. The best BDCs are managing risk by diversifying portfolios. BDCs are precluded from putting too many eggs in one basket. No loan or equity position can account for more than 25% of its total assets. Which BDC has the best credit rating? Ones that can borrow at very low rates. Banks define interest rates by measuring risk depending on strength of balance sheet. BDCs with very little debt can borrow more money at lower rates. BDCs with low debt. Federal rules say that every dollar of BDC debt has to be covered by $2 of assets. A lot of BDCs borrowing every dime they can. A lot of BDCs borrow every dime they can. Others borrow only when they find a compelling opportunity. Like ours. A BDC with no capacity to borrow doesn't have the same options that a BDC with more modest debt may have. If the economy worsens, BDCs with more borrowing power can take equity stakes in companies that need financing to weather the storm. If times are good, they are in the best possible position as they can take whatever opportunities they want to help finance serious growth. Insider commitment for BDC. Select companies with strong insider ownership, as this is an indication of a BDC's strength. If board and executives own shares, it indicates their commitment to excel. Dividends of BDCs. Stability shows a company is making loans that are getting repaid, especially if the company is paying dividends monthly. Looking for BDCs that are paying increasing dividends. Performance of BDCs. Above average performance is key. Invest in BDCs that have delivered consistent, above average gains over a long period of time. The relative strength index will be used. Europe's largest institutional investor. Insurance companies are Europe's largest institutional investor with assets of 7.7 trillion euros in 2011. Total assets under management in Europe, 15 trillion euros on December 31st, 2011. Banks had lending assets of approximately 6 trillion euros but are not considered institutional investors. Pension funds, 3.7 billion euros, that's 24%. Endowments and foundations, that's 300 billion, 2%. Retail mutual funds, 1.7 billion, that's 11%. High net worth individuals, 1.2 billion, that's 8%. Europe 2020. Business is all about innovation and marketing. Europe needs more business, more growth to create more jobs according to its annual growth survey of 2014. The biggest challenge facing Europe's economy is how to sustain the recovery that is underway. Europe's Commission's Euro 2020 initiative seeks to deliver a smart and sustainable strategy for growth that will create a competitive economy with higher employment. EU's low interest rate dilemma. Swiss Re's latest Sigma study explores how interest rates affect insurers and why low interest rates are particularly strenuous for life insurers. Interest rates have been falling for decades and are now very low. Performance of BDCs. Result analysis. August 13, 2012 to August 9, 2013. Triangle Capital cost basis. $24.58. Dividends, $2.13. Adjustment basis, $22.45 price, $29.34 gain, 30.69%. Main Street Capital, cost basis $26.52, dividends $2.32, adjustment basis $24.20, price $30.94, gain $27.85. Fifth Street Finance, cost basis $10.51, dividends $1.20, adjustment basis $9.31, price $10.81, gain 16.11%. Apollo Global Management, cost basis $13.52, dividends $1.98, adjustment basis $11.54, price $27.96, gain 142.46%. Now that's incredible. KKR, cost basis $14.24, dividends $1.63, adjustment basis $12.61, price $20.15, gain 59.79%, which is still pretty amazing. S&P 500, cost basis $1,405.87, dividends 33.71, adjustment basis 1,372.16, price 1,691.42, gain 23%, 37. These 5 BDCs with a performance of 55% outperform the S&P 500 by 37%. Asset liquidity. Asset liquidity versus asset duration. BDCs on the US stock exchange are far more liquid than private equity funds. Insurers' structural investment advantage. Private equity offers high yields, but BDC innovation growth funds would offer more liquid and higher performance. Thank you very much for your attention. Any questions, call us on 0845 868 8221 or email us at ir@wellclar.com or visit us at www.wellclartrading.direct. Thank you. Goodbye.